Yields back up as data beats expectations for a change. Stocks hold on to gains, but gold breaks down as the dollar wrecking ball continues to march higher. CPI data out this week will be key, plus the start of what could be a pivotal earnings season. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 12th of July, and let's have a look at these markets. So where are we? Last week, what did we have going on last week? Stocks, continued to rebound, led by tech, as we have got sort of better than expected PMIs, services PMIs, even though they weren't exactly great, but they're still better than expected. And then the jobs data also provided some optimism around a potential soft landing. Well, that's what people are saying anyway, right? And so whilst, we thought certainly the rates market seems to be in the good news is bad news sort of camp, equities managed to actually stage a little bit of a rally last week. Although that seems to have been quite short-lived as we've drifted back down now. Credit spreads also tightened with the risk off tone. So with the risk on tone, yields moved higher with the US 10-year back at 3%. And, we're the good data countering the recent recession fears that have been what, created the bond rally and took yields down. So all eyes are really going to be on the CPI this week, right? Because to see if we're going to get confirmation of these yields kind of going back up again or not, basically, right? If we were to see a big sort of downside surprise in CPI, then we may well have lower bond yields before we know it, right? So a few big macro commentators around are starting to nibble on long bonds and increase their conviction on long bonds. So something to kind of be aware of there. So you can see the market movers here, usual sort of graphic. So we've got our kind of alphabet, Apple, NASDAQ, etc. up. We've got the front end yields and the US 10-year up as well. On the downside, obviously commodities, gold, the worst hit. So that kind of broke quite key support around that 1760 area, which we had been watching, and kind of took a quick slide down, sort of 2 standard deviations. And the rest of the commodities kind of, in general, also remaining quite heavy, right? A bit of a bounce in ags, but a lot of the space like metals, for example, and uranium and things like that staying heavy, yeah? In FX, the dollar continues its advance. Obviously, euro really getting trashed, testing parity, tested parity sort of earlier, well, pretty much there this morning. If I look to where it is now, it bounced a little bit from those levels. So, but yeah, we've been talking about that, right? That break of 103.5 was really the kind of acceleration zone where it looked like a parity test was on, basically, and we got it pretty quick. Yeah. And then obviously the dollar pretty strong against all currencies as well. Dollar yen making new highs, commodity currencies down against the dollar as well. Okay. But euro really the epicenter of the pain, where it feels like, with the worsening energy crisis in Europe and a central bank that has limited tools to fight that, a recession is getting priced into Europe, and it's certainly getting priced into the FX. If we then look at some of the stuff that's been around in the macro space, Macro Alf always puts out a great piece. So kind of summary of some of the stuff he's been saying. If we look at, he's looking at his global credit impulse, saying that that's really rolled over pretty steeply, trying to ascertain whether we are getting a recession or not, basically. Okay. With the steep rollover in the global credit impulse, I don't know exactly how he calculates that, but he obviously looks at a variety of measures. Trying to ascertain, how much credit is in the system, either being withdrawn or being added. And that tends to give you a 6 to 12 month lead on S&P 500 year-on-year EPS growth. Okay. So this very steep rollover that we've seen suggests that we're going to get this EPS growth coming pretty negative, right? And over the next few months is what we're kind of thinking. Yeah. So we may get this Wile E Coyote moment in EPS growth that people are talking about. Okay. He also cites some concerning signs in the labor market. So despite getting a non-farms beat on the headlines, if you were to look at initial jobless claims, right, and the trend in initial jobless claims and compare that, the moving average of that and the rate of change of that, then there is a risk here because, we're starting to see the kind of numbers in increases in jobless claims that we tend to see preceding a recession. So if you look back at past recessions, those are the kind of numbers we've seen. So if that persists for another couple of months, then that doesn't look good basically for the labor market. Yes, so that's more of a lead indicator on the labor market than maybe non-farms, right? And we were also saying last week that some of these tech layoffs were a little bit concerning. The rate of change and how that's exploded was a little bit concerning. So maybe the kind of non-farms numbers aren't telling the full picture. Yeah, and then if you look at more market-based indicators, so the prices of things and where things are trading, obviously copper has had pretty much one of the worst 1 month drawdowns it's had ever. Okay, so 25% drawdown in a month, very a massive statistical outlier, suggests that there's something not so rosy going on in the global economy. Yeah, and then the US rates market is obviously pricing in cuts. I mean, it's reverted a little bit in the last few days, but since the non-farms, but it was pricing in aggressive cuts next year. So basically saying rates were going to peak at the end of this year, and then they're going to take 100 basis points out of it by the end of next year, which is pretty dramatic and pretty much the most dramatic cut in rates after a hiking cycle, like in terms of speed and ferocity, that's been priced in ahead of time. Obviously, we saw a massive U-turn in rates in COVID, where they just took rates to zero in no time, but that wasn't being priced in the market ahead of time. The fact that the market is pricing that ahead of time is the unusual thing right now. Yeah. So anyway, the bottom line there really being, whilst many people are joining the recession call finally, they may still be underestimating how bad things could get, according to Alf, basically, right? So that's kind of how to summarize his latest piece, but always a good idea to listen to the piece yourself and see what you can glean from it. So we said all eyes on CPI this week, right? So what are we thinking there? Recent recession fears have obviously fueled this bid back into bonds, although it's started to drift off a little bit now. And we've got high profile macro guys saying that rates have peaked and the euro dollar curve is pricing in aggressive cuts for next year. Now, what's interesting is we've definitely got a polarization in the market. Some people think rates have peaked and some people think inflation has still got some to go, right? It's not going to disappear that fast, right? So you've got Jim Bianco, who I have a lot of respect for, and he was very right on the inflation call, right? So definitely recommend you're all over his research and what he does, right? He points out that, the base effects starting next month are really going to make it hard for the year-on-year inflation prints to come off significantly, right? Because you look back at a year ago, that's where you had your lowest kind of prints month on month on inflation, right? So once we get into July, August, and September, those base effects, you're likely to basically be having higher month-on-month inflation now relative to that. So your year-on-year is going to look quite high. So with those high year-on-year numbers, which the Fed look at, they're not suddenly going to be able to stop hiking rates, right? They're still going to be under pressure heading into the midterms with high inflation prints persisting. They're still going to have to keep on pace for like this kind of aggressive tightening that we think they're going to have to do. Okay, so that's one thing to be aware of. And then the flip side of the argument, obviously, is that the components that are responsible for most of the spike, like motor vehicles, transport services, these are all the things that are expected to fall. So you should see a fall in CPI, provided those commodity prices and things that feed into them do come down. I guess the only problem there is that, commodity prices are volatile, right? Yes, they've retraced quite a lot, pricing in a recession, but how much of that is now priced in? Some people are thinking copper's already priced in a pretty bad scenario. If you compare it to the longer term need for copper versus how quickly it's repriced, it's a bit of hard one to call, basically, right? If commodities need to bounce from here. Now, obviously, commodities did try and have a little bounce. We saw a bounce in like the likes of natural gas, ags, and even copper. Once it got to around 330, it bounced back above 350, but that's kind of got whacked again because we got some bad news out of China on COVID, basically, right? So all of a sudden, the risk of China lockdowns again. Macau is shutting down casinos in Macau again, and that concern's back on the table, basically. Yeah. I mean, I'm not going to predict what inflation does. I've got no edge in that, but I would say that I can definitely sympathize with the call that it's going to be stickier than people think, right? So I'm not convinced that it's going to roll over that fast. And the reason I say things like that is because, a lot of the things that are driving inflation, like, I mean, obviously we could talk about core versus including food and energy, right? But if we just talk about including food and energy for a minute, I mean, the prices at the pump are a function of crack spreads as well, right? And whilst Biden's releasing a load of his SPR and draining that down in an attempt to bring crude prices lower, it's ridiculous because there's not enough refining capacity to allow pump prices, product prices to come down. That's where the real shortage is, not necessarily in crude. And Eric Townsend of Macro Voices was saying that from draining the SPR, they're then ending up exporting it to China, right? Because that's not the thing they need. The thing they need is products, but they don't have the refining capacity to make the products. So there's quite a lot of complicated stuff going on in the commodity market and what's then feeding through to inflation. And then obviously you've got the stickiness of the rent prices that are still kind of grinding higher. They're not going to collapse. They're a lagging thing to the housing market. So I just think, and then obviously got the wage growth, right? And, look, in theory, we've still got a tight labor market. I guess we'll find out in a few months how tight it really is. But people are thinking we've got a tight labor market. That might be, again, a persistent thing for inflation, right? So I do sympathize with that fact. So I'm not calling the end to inflation yet. But then the market's forward looking, right? And inflation break-evens are rolling over. They've rolled over steeply. The bond market's obviously started to rally. So it's kind of hard to know. I mean, this is why you've got this really funny shape of the curve in the rates market where they're not letting front-end rates sell off. They're not letting front-end rates come down, i.e. Interest rate futures rally in the absolute front end, but they're just taking everything else down because they're saying, okay, inflation might stick around for another quarter or two, but then it's really going to collapse. And that's what the long end of the bond market's kind of trying to say, I think, basically. But we said that vol targets beta to the market's quite light at the moment because obviously realized vols are generally quite elevated if you compare them to longer term histories, right? So that's this kind of blue line down here showing the notional of these vol target funds and how long they are the market, essentially, okay? And then you've got the realized vol up here, 1 month and 3 month on the S&P. And you can see the 1 month has started to tick down to kind of almost cross back below the 3 month, okay? And then you've got the realized vol data in sample here. So what this is basically saying is in the sample, we've got yesterday we had the 2.4% move drop out of the sample, okay? The next day, so today we're having the 2.9% drop out of the sample and then a 3.9% the next day. So there's some really chunky moves a month ago that were elevating the realized vol. And as they drop out of the sample, unless the new moves today, yesterday, tomorrow kind of make up for that, you're going to see realized vol tank, right? In terms of that measure. And if that measure was to tank, then these vol control funds then have to come in and buy some delta, right? And that's down here. It's not that easy to see. Let me see if I can zoom in on it. But basically here you have this thing basically saying that in the market sort of unchanged scenario, they've got $3 billion to buy. Okay, if the market down 50 bips or a percent, they've still got about 3 billion to buy. Market up 0.5% to 1%, 3 billion to buy, because that's not materially changing the realized vol. If we start to break out of that range and you see big moves like a 2%, 3%, 4%, that's when the realized vol spikes and they have to de-risk again. So they turn from being a buyer to a seller, right? So, in the absence of any other material market moving flow in the next 3 days, so Monday to Wednesday, because earnings don't kick off until Thursday, like the bank earnings anyway, right? Obviously, you've got CPI tomorrow, so that may move markets, but there is a marginal buyer here if not a lot happens that may support the market in the first half of the week at least, right? Once that's gone, then maybe that bid's gone away and we actually get some data that makes the market more bearish maybe, and then we can sell off. But it seems like that should be a net supportive factor for the market, that what's going on in the vol control and what's going on in that calculation period right now. Yeah. So I thought that was quite interesting. So, early last week, it kind of had this dip back again to that 37.40 area, bounced strongly off it and kind of rallied into the rest of the week. Like I said, on better than expected PMIs and non-farms beating expectations. Okay. So basically the labor market suggesting that we might not be in a recession yet, which is contrary to what like the Atlanta Fed nowcast was saying the week before, and everyone got spooked. Okay. So we're just getting a lot of mixed signals all around the place. Okay. But the argument, we're thinking that data might keep the pressure on the Fed to stay tight. So then it's probably not that bullish news, right? So it was kind of surprising, really, to me that the S&P popped its head above 3,900 post non-farms. I thought it was going to get faded, and it just needed to wait until the weekend to get faded, basically. So it has been faded eventually, but that's been helped with the news that China COVID is back, so potential, issues there again, and then Europe's obviously a bit weak. With what's going on in the gas market, basically, right? So those have been kind of the excuses been given to the weakness over the weekend. But to be honest, I kind of think that rally was just a bit out of place on that non-farms number, given what the rates market was doing anyway. Yeah. So in terms of levels, 3,900 seems to be the kind of resistance area on the upside, and kind of a pivot point where the street is less short vol, was probably a bit getting towards like flat to long vol above that area. That's kind of what the gamma models out there are kind of saying. Obviously, you can believe those gamma models or you can take them with a pinch of salt. That's up to you. But whilst their absolutes might be wrong, the absolute levels might be wrong, I kind of think the rate of changes make a bit more sense. So if you're seeing a significant increase in gamma positioning from 38 to 3,900, that is probably the direction with which the gamma positioning is moving, right? If we do go up there. So I that's why I put some weight on that. And then a break below 3,800 is probably what you need to really flip into sort of negative gamma, where you're going to start to see some more consistent realized volatility again, basically, right? So at the minute, we're kind of in no man's land between 38 and 3,900. If we were to get a catalyst once that vol control buying is out the way, then we may be free to see a break to the downside on that, basically, right? So I wouldn't get overly bearish until that's out of the way, obviously, unless those levels start to break, and then you can lean on it. But I think we might have a bit of a support bid for the next couple of days. Yeah. What does that say, really? That just says that selling rallies continues to look sensible, right, in this environment. Owning puts is a much higher conviction, bearish conviction trade. Okay. And if you're doing it, you probably want to push your maturities out to September or even longer, to give yourself comfort that you've got enough time for the sell-off to materialize and play out, right? Whereas selling calls in August or September feels like a much higher probability winner at the moment, right? Is, this kind of what's going on in SKU, what's going on in VIX and the VVIX, okay? And just, really just trying to kind of rationalize and understand it a bit more, okay? We've got SKU, the SKU index, kind of back trading, near the low end of the range. Okay, so SKU's been unloved for a while. We know that, right? Because it just hasn't performed. We've shifted down in market from 45, 4,600 down to where we are now, and vol has just kind of stayed the same, right? It's kind of stayed in that mid to high 20 area. It hasn't really got going as you might have thought it would break 40 or something. It hasn't really happened. Okay, so you can see the chart over here shows you the VIX versus things like FX vol and the move index, which is rates vol, and the VIX is just kind of chilling, going nowhere, and all these have like gone consistently higher. But that kind of makes sense because those things are actually moving and they're realizing a lot more, right? So the realized vol in those other asset classes is justifying a move in the implied vol. Problem for equities is the realized vol just isn't justifying it, right? And that's because when you're seeing large moves in the dollar and large moves in rates, those are creating rotation under the hood in equities, right? They're not necessarily creating broad-based equity vol where the S&P index has to get annihilated, right? they're creating these vicious rotations under the hood, either into defensives and out of cyclicals, right? Or into growth and out of value, or the other way around. That stuff can happen without the broad index doing that much more than it would normally do. And that's really what's going on there, right? So you need to see not just other asset classes going crazy, you need to see some reason why broad-based equity is going to sell off if you're bearish. And we think that if that is going to come, it's going to come from earnings, basically, right? It's going to come from a derating of earnings for the rest of this year, pricing in the fact that, you know, these are out of sync with what we think about growth, basically. Yeah. And then the chart at the bottom, I've just kind of highlighted in the green vertical lines, you know, all the times where the VVIX versus VIX ratio spikes down. Okay. And that's something Darius Dale looks at 42 macro, right? As kind of a barometer for risk off, right? Or like a bit of a capitulation type environment where VVIX versus VIX spikes down. It means the VIX is typically spiking, and it's spiking more than the VVIX, right? Which is a capitulation type, get me out type price action typically, right? And you can see that, yeah, when that blue ratio does drop, typically it's associated with the spike in the orange line, which is the VIX. So I've got the ratio in blue and I've got the orange line, which is the VIX. You see most of those downside spikes are met with a VIX spike, okay? Whereas right now we've got the VVIX-VIX ratio down here at levels that are consistent with previous spikes in the VIX, and yet the VIX isn't spiking. So the VVIX-VIX ratio collapse is not due to a VIX spike, which you normally get. This time it's due to a VVIX getting crushed. Are at levels on the DXY that we have not seen in quite some time, right? I'm going to the point where I need to switch it to weekly to be able to see it, right? So this is near 10-year highs now, okay? So, I mean, it's really, I mean, it's been overbought for ages, right? But it's at 10-year highs. So it was up another 1.5% last week, okay? Obviously with the euro weakness. So it was broad-based. We had cable sell-off with all the shenanigans with their politics and Boris being forced to resign. We had yen continue to weaken as BOJ reiterate their policy. And then we had euro rolling over on recession concerns and what's going on in the gas market and the energy market over there, right? So these are all factors that have led to this dollar just charging higher. Even against commodity currencies as well, it's been strong, okay? So I mean, whilst it's hard not to expect some consolidation at these levels, right? Because these are pretty steep levels now. The fact that, you know, the market's already pricing in cuts for next year in the euro dollar curve means that if we were to get a hawkish reaction to inflation data, that could fuel even more dollar strength potentially, right? So I'm not ruling out a move up to 120 on DXY by any stretch, right? So I mean, for now, I don't see a good reason to fade this. I have taken some profit on some stuff, and I'll talk about that when I talk about euro. But yeah, at no point I really don't see the point in fading this, given that it's actually accelerating, right? The type of move, if you zoom in on the move, right, the move is accelerating here, right? So it's kind of, it's not a choppy sort of ascent like we got, you know, in 2019 or whatever. I mean, it's feeling pretty parabolic, right? So fading parabolic moves is a dangerous game, I would say. Okay, so and I'm certainly not doing it. Okay, so that's the DXY. And then the last thing on commodities that I wanted to talk about was gold. Okay, so I've got the gold chart here. I mentioned 1760 was a bit of a support. It broke it, went quickly to the next one at 1725. That's kind of the level that needs to hold. Really, otherwise it's probably going to test that low level at 1680-ish. And if 1680 is broken, then all hell breaks loose, and we've got potentially back towards some kind of 1500 type area, right? So that would really hurt gold a lot if it couldn't hold on to 1680s. Yeah. I've also superimposed the real yields on here just to kind of keep an eye on 10-year real yields. And we see, you know, whilst 10-year real yields is an inverted chart, obviously, on real yields, whilst they move back towards their local highs, like around 60 basis points, I think it is, then it makes it very hard for gold to rally. And then also the dollar strength, that also plays its part, right? So a combination of dollar strength, higher real yields is going to make it pretty hard for gold to rally. I've been bearish gold for a while, as you know, and it seems to be playing out that way for now. Yeah, I did take a little bit of profit because we'd had quite a nice move on some sort of in the money stuff that I had, but I've still got some exposures to the downside in gold, basically, tactical exposures. Yeah, for the next sort of 2-3 months out. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.